Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next 25 minutes or so. This week on Options Guide TV, we're going to focus on a couple of the strategies that we've decided to use to get bullish on the marketplace going into the holiday season. Solid news that we are getting from a lot of the retailers. The CEO of Walmart was on a show today talking about how they were surprised how strong the consumer has been. And I think the economy in general has been surprised by the consumer. Obviously, the fact that inflation is coming down is what the Fed is trying to accomplish. That we're having deflation is the word that they like to use. And the fact that we still have low unemployment, we still have wage growth. We do expect some slowing in the economy, but there's a lot of talk right now that maybe even the soft landing, I guess we could say that we're in that landing right now. We're approaching the runway, if you will. It's still a concern about what may happen to the marketplace with the way that the Fed has increased rates so rapidly. But if we look once again at the CME Fed Watch tool, which uses the futures market to try to guess, or I guess guess would be a good word, when the Fed might stop raising rates and start cutting rates. And the probabilities are increasing precipitously over the next going into 2024, getting into March. The March expiration now, they're saying there's a high chance of a rate cut. The June expiration, there's even a higher chance. So as we go throughout the year, the futures contracts, which I have to let you know that they're not as accurate as they are on the shorter term. And that's just in general the truth with a lot of these tools that will try to track what the Fed is doing. But it's just interesting to see that it's even on the table, let alone the fact that it is increasing in the probability of a Fed rate cut. So our plan over the last few months in September and October were to stay bearish just because of the seasonality of the marketplace and other things that were happening. And then we wanted to start to get bullish going into the holidays. And we've decided to do this by creating a portfolio of deep in the money options using the paper trading app inside the TradeHawk software over at Tradier, who is now currently, I'm going to highlight this. Let's run to the options playbook real quick, because we're going to talk about this strategy and highlight that Tradier is now the broker of choice on optionsplaybook.com. So if you are interested in Tradier and seeing the what if calculator and how awesome the options grids are for the TradeHawk software, please go ahead and check it out and even sign up. We got a special offer here for people that are signing up via the options playbook. And we recently released a new version of the Kindle options playbook, if you were interested in that. Okay, so with all that said, minus that little commercial there, we decided, alongside our paper trading portfolio, and I tried to jump between portfolios last week. We've been doing some speculative trades along earnings, a lot of them. And it's not always that we're going to trade our portfolio that way with a lot of the speculative trades. We just really want to try to learn about option pricing. And you can't just talk about covered call writing nonstop, or the show would probably get pretty boring overall. So we're trying to we have all of these different strategies inside the options playbook. And our goal is to try to find situations where they may work. And the reason why I'm going through this little scenario is I really like what has happened with our skip strike butterfly. And I want to talk about the pricing of it because skip strike butterflies to me are probably the most interesting trade in the marketplace. I'm not saying it's my favorite trade. I don't think that all you should do is skip strike butterflies. I just find it to be a very interesting trade if you're trying to understand how options and option pricing works. And so I thought I would step back. We when we initially looked at this trade, I talked a little bit about the setup and why I prefer the name skip strike butterfly as opposed to a broken wing butterfly or a modified butterfly. A modified one is another name that I should probably add to the AKA in here. Split strike butterfly, I don't hear that often, but when we skip a strike, uh, this no longer becomes a standard butterfly. And it actually, by doing this simple little move, by not buying the ABC equidistant apart like a standard butterfly would, we effectively embed a short spread inside the skip strike butterfly. So what I'm going to do is talk a little bit, I spend a little bit more time inside the options playbook, demonstrating that concept. And then we're going to go back and look at our trade and see how the trade is working out. I find it very interesting. We put this trade on Friday, mainly because we actually had the success of our long call spread that we did the week previously, and we will see how, my expectations for the skip strike butterfly going forward. Okay, so here's the skip strike butterfly. Here is a long call spread butterfly. Just a long. Let me say that again. Long butterfly spread with calls. So here would be the standard long butterfly. We would buy strike A, go, in our case, we were going 10 points wide. We went, because we're using the S&P 500 index, good old SPX. We would buy strike A, go 10 points up, sell 2 of strike B, and then go another 10 points up and buy strike C. And I say up because we're doing this with calls. We have a bullish spin to it. If we were bearish, we would use puts. We'd use the out of the money puts and point in that direction. Now, by skipping this strike C, which means that, I mean, in a way, you can think of it that we bought and sold it. That would be one way that you could skip it. But I only bring that up because if we did sell strike C, then we're going to go out and buy strike D. So if we bought and sold it, the concept is that you are selling selling this strike to create that short spread. So your risk when you do that, this would be strike C and strike D, is going to be the width from that strike that you skipped to the strike that you bought. So we're embedding risk into the trade, and the brokerage firm is going to be like, ooh, you don't have limited and known risk anymore. Well, I guess we have limited and known risk, but you have added risk to this trade. So we're going to want to hold out a margin requirement to cover that risk, just like you would if you looked on the short call spread. If you did the short call spread, you see here that the margin requirement is the difference between the strike prices minus the net credit received. And we always highlight those margin requirements inside the options playbook. But that would be the traditional margin requirement that you would have to have in your account to do a short call spread. Okay. So we buy the long spread, we skip this, we embed the short call spread, which adds risk to the trade. We see how much lower below the x-axis we go. And when you combine them all, it looks like this. Now, a big goal is that you sell that short spread in theory for a much more than the butterfly. So you're hoping that this credit from this spread pays for this debit that would be created from that butterfly. Hence the reason why I like the name skip strike butterfly. And if we do that, then you'll notice from strike A on down, we have a potential for a profit, a small profit, but we have a potential for a profit. Now, some people look at this and think of this as an alternative to a butterfly. I would like people to look at it and you can look at it with two different eyes, right? It's kind of like one of those pictures where somebody looks at it and sees the dog, and another person looks at it and sees a car. That type of thought. If you're a short call spread trader or a short put spread trader, if you want to be on the other side of things, this is an alternative to doing that short call spread. Instead of doing this short call spread where you have a small amount of upside with a lot of downside, you're still going to have the downside from doing the skip strike butterfly, but you automatically have a hedge in on that trade. And this is happening. This is playing out in real time from Friday when we put the trade on. And that's why I thought I would take a pause today and go into detail about why I chose that strategy and what's happening with that trade. All right. So before I run back to the TradeHawk software and talk about the options grid and go into the what if calculator, I'm going to just take a peek at the CME Fed Watch tool, only because we're still in the browser. So I've mentioned this at the top of the show. And if I go out to the March meeting, which is March 20th. Now, if you run into this, it actually shows you at the top of the screen how many days until the next Fed meeting. So this is always a great place to even find out when the next Fed meeting is coming. This tab shows the December expiration, which is 7 days, not expiration, the December meeting, which is 7 days away. Here's the January meeting. January meeting also is showing a possibility of a rate cut, a small probability would be a better word to use, of the rate cut. But the current rate is here, 525 by 550. So they're saying there is a higher probability that they would cut rates in the January meeting than they would increase rates. But where it gets real interesting is when you click on that March meeting on March 20th. Now, remember, 525 by 550, that's right here. They're saying there's only a 40, I'm rounding off here, a 40-some% chance of the Fed actually keeping rates where they're at. There is a 50-some% chance that they will actually cut in that March meeting. So very interesting. You go out to May, you go out to June, you go to July. And once again, it's less accurate the further you go out in time. But very interesting to see where they think that Fed funds rate may go to based off of where these longer term future contracts are trading at this point in time. Okay. So let's, I like that. I like what just happened there. Let's go to the TradeHawk software and I have the trade all set up. Now, on Wednesday, I struggled a little bit because I was trying to go between the paper trading platform and the actual TradeHawk software, which meant I had to log out and log back in. And that didn't work. So I'm not going to try that anymore. We do need to add some positions to our long-term fig leaf portfolio. And we are in danger a little bit with Schwab. We gotta watch out on Schwab because we've sold a call at the 64 strike. And we're really worried about this getting called away. Schwab has made a real strong move recently. A lot of the financials have. And it has a lot to do with what's going on with the interest rates and everything that we just showed you in the CME Fed Watch tool. But with that said, this is one that we have to watch. So we may have to roll that position. Coming back over here, here's our trade. Here's our skip strike butterfly. SPX 45.76. We put this trade on last Friday going into the weekend. And I did that trade going into the weekend as opposed to a long call spread. which is an alternative trade that I like to do if I want to get bullish in an index. And when we put this on, and I'm looking at the screenshot from the day, the market was almost exactly where we're at right now. To the penny, it was 4572.97. So look at this. We're at 4575.52. Okay. So we put the trade on. The market actually went down. We established this trade where we went out, we bought the 46.40, sold the 46.50, and skipped the 46.60 and bought the 46.70. We did this for a net credit to the account of 60 cents. Now, this is the long position. We would have to unwind it by closing out the positions. Instead of buying to open, selling to open, buying to open, it would be sell to close, buy to close, sell to close. That's the way the order ticket would look. And we can get out for basically even right now. Limit price, well, right now it's showing a net credit of 5 cents to establish the trade. That means, well, we'll just call it even. It keeps flipping back and forth. So we put it on for 60 cents. We could close this trade for 0. And hence we would make 60 cents on the trade. That would be the theory of the trade. Now, what happened was we put the trade on and the market went down. And this trade became profitable almost instantly because the market went the opposite of the direction of what we were intending from the skip strike butterfly. And that allowed some time decay to happen. And I'm going to go to the what if calculator. I'm going to kind of show you what is happening as of today in this position. And then the market came back. And now we're right back to where we were. So we did get some time decay that helped us out. We still have 2 days remaining of that expiration. I should probably highlight that too, which is December 8th. So we're December 6th right now. And we're highlighting over here that it's December 8th, which is this Friday. These are the W options, which are considered the weeklies, even though we have many weeklies that go out over a month in time. But the weeklies are highlighted in yellow. The standard SPX is highlighted in green, but this means that all day Friday, these option contracts will trade. Okay. So the what if calculator I have already set up. So I took the trade and I put it inside this awesome calculator inside the TradeHawk software. And here's our last trade, 45.74. So this is a live market and it's showing you what's going on. Now, the profit and loss graph on our graph from the initial trade would be a little bit higher because we did it for a net credit of 60 cents. So it would be somewhere right around here. But now, since it's trading for even, this is where we are at on this trade. So I bring this up in that the way the markets are going, the way the chart looks, which I'm not going to get into too much detail today on that, and the fact that we've already established this position, I wouldn't mind adding to it going into Friday. If I could get this done for even, if I could do this trade, we usually on Options Guide TV, we just do it on a one lot, and you would decide in your mind if you're paper trading it, how many different units of the butterfly that you would do. But the market went down. We were profitable. We could have made 30 cents right away because it went this direction. The market came back. Now we are up 60 cents on that trade. Add to that position. And we would really like, now hold on to your hats here, because this is what's very weird about this trade is we would actually I would like to be down money on this trade by the end of the day. Not a lot, but I would prefer to be down some money on the trade. And here's why. The market goes up as of right now using the theoreticals inside the TradeHawk what if calculator, and it goes up to 4,600. We're actually going to be down on the trade. Look at the green line. If it goes up to 46.10, we're going to be down a little bit more. But if it skyrocketed all the way up to 46.70, then we're going to be down a lot on the trade. So I wouldn't mind if the market started going this way because we have 2 days remaining to expiration and time time decay is going to start setting in. And if that does happen and we start going in this direction, oops, why did that happen? All right, so now I got to zoom back in again. I clicked on the button by mistake. So now if we go in this direction, eventually this green line is going to morph into the profit and loss graph at expiration. So this is a trade. I really liked what happened with the trade. You can't plan it out better than the scenario that we did when we put it on. The market went down. We got profitable on the trade right away. That was the only way that we could be profitable instantly on that. Well, ideally, the real only way that we could be profitable is just like if you took the concept of selling a short call spread, the market goes down, you make money, right? In theory. So that happened, but then the market came back, and now we've had some time decay, able to get it done for a real good net credit of 60 cents on Friday. We are now up 60 cents, and but we still have this slow way that we could become even more profitable on the trade. Now, if we had done just the short spread, our net credit would have been higher, but we wouldn't have this potential for, I guess, lack of a better word, a home run. We would really like the market to be right about here on Thursday, just so you don't get nervous, and then close somewhere within this range on Friday. And I would actually put on another trade today for if I could get it done for even. And if we talked about this in a 5 lot, but we that means that we would have one skip strike butterfly done for a certain dollar amount, and then we'd have a second one done for net even. So one done for net credit of 60 cents and a second one done for even. Now, what's real interesting about the skip strike butterfly and the way that this trade is playing out is that if we get to expiration and we do land somewhere in this range, we're probably putting that trade on for a net credit, and then we're unwinding it, closing all the legs for a net credit. So it's interesting to be able to put a trade on for a net credit and close it for a net credit at the same time. So that potential is there. Now, the maximum we could trade for would be $10. The width between the 46.40 strike and 46.50 strike. That's the maximum to trade for. Now, if you ever get that, I also say you should, usually will say you should get the stupid award for that too. And that's mainly because you should have probably been out of the trade earlier. You shouldn't just ride it all the way to the end. But it does matter. I mean, it's possible if you had more than one of these on to sell part of the position and then let the other part ride. So interesting trade. I thought I would take a step back, go into detail about it. I still want to put speculative trades on around the paper trading portfolio that we're trying to build out for 2024. That portfolio of deep in the money option contracts, we're going to be selling some calls against it. The downside is my favorite vehicle is the SPX to trade these type of strategies in, and rightfully so. In the paper trading accounts, SPX quotes aren't free, so it's hard to offer. I don't know. I don't think hardly any brokerage firms offer a paper trading account that gives quotes on indexes. That's straightforward. So if you have any questions, please do put them in the chat box. And we do want to make this interactive. Please check out optionsplaybook.com if you have any questions on any of the strategies. And please follow me on Twitter. I'm going to start putting out more information on Twitter. My handle is @BrianOverby. Click subscribe and pound and ring the bell so you get all the alerts, and then pound the thumbs up. And that's it. That's all your homework for this edition of Options Guide TV. We'll see you this Friday. We'll see how this trade works out. and we will start looking at our paper trade portfolio and making some adjustments. We got a close eye on Charles Schwab and our short call strike at 64. Thanks for coming, everyone. See you this Friday.